Good evening, hello and welcome. You're watching The Money Show. I'm with you, Kavita Thabliyar. This is a one-stop show where we answer all your portfolio queries, and we also talk to you about all the investment instruments available as per your risk appetite. Today on the show, we'll be focusing on your portfolio queries, and we'll be also helping you navigate all your financial goals with the right kind of investment strategies. Just in case you want our help from our experts on your portfolio, on your investments, to send across your questions on the WhatsApp number that's flashing on the screen. We also have an email ID where you can reach out. When you give us your details, please give us your current investment details and your corpus that you want to accumulate for each financial goal. That will help our experts to align your strategies with your financial goals. But let's begin. Today on the show, we have Samir Shah who will be answering all your queries. Samir, hi, good evening, and welcome to the show. A lot of questions, and every question has a very interesting aspect when we talk about investment strategy. So we'll be focusing on that as well. But let's take Swapnil's question, and he has a couple of funds in his portfolio. He's investing via SIP in Parag Parikh Flexi Cap, 5,000 rupees. ICICI Prudential Commodities Fund, 2,500. He's also invested in Motilal Oswal Nifty India Defence Index Fund, 2,500. DSP India Tiger Fund, 2,500 investment going on, same amount in UTI Nifty 50 Index Fund, HDFC Large and Mid Cap, SBI Gold, Quanti LSS, HDFC Small Cap, HDFC Mid Cap, SBI Mid Cap, Nippon India Multi Cap, Quant Small Cap, ICICI Pru Aggressive Hybrid Active Fund of Fund. He also has Miraset Large Cap Fund, 10 years time horizon, 2 CR is the goal. He wants to know if this particular fund mix is good for him or not. Okay. So let's begin with cutting down or telling him the exit strategies from the funds that's needed first, because too much of overlap.
Good evening, Kavita ji. Thank you so much for having me here on your show today. Exactly. You have rightly pointed out, Mr. Swapnil, you hold close to 15 schemes in your portfolio. Ideally, what we recommend is you should have 4 to 5 high performing scheme for your whatever goal you are chasing, right? So first is there is immediate need to cut down your portfolio. Just because there is lot of overlapping happening amongst the funds. Say if we talk about there are 3 mid-cap funds, one large, 2 mid-cap fund, 2 large-cap fund, one large and mid-cap fund. If we put together all 5 funds, more or less 45 to 50% stock overlapping is there. So our suggestion is that rather having multiple stock here, first we have to reduce number of schemes. So our recommendation will be here is you can have one large cap fund, one flexi cap fund, and say from your portfolio flexi cap flexi cap category, you can keep Parag Parikh Flexi Cap Fund. As you already have an index fund in your portfolio, that is UTI Nifty 50, you can keep continuing in this fund and merge the rest of the funds. The third is you have one mid-cap fund. HDFC mid-cap is doing good in your portfolio, so you can keep that and merge other with this. There are 2 again small cap fund. Suggestion is that you can keep, both are good fund. You can keep any of them. Technically, what we suggest is as we are doing SIP in gold, so you can keep fund. Now, looking at your portfolio, you have invested into sectorial fund, infrastructure. I've seen defense and infra sector you have invested. As you have a flexi cap and other category of fund. See, sectorial fund can be invested for a short-term move. Say when you are expecting some spike in that particular sector, that point in time you have to invest. Rest, as you are investing for 10 years time, your investment time horizon is 10 years. So suggestion is that instead of having infra or sectorial thematic fund in your portfolio, suggestion is that you can divert that fund to flexi cap fund. So by doing this, this activity, you will reduce your fund from 15 to 5 to 6 fund. Another observation from your portfolio is that you are doing SIP in Quant ELSS fund. If you have opted a new tax regime, in that situation, I guess that fund also need to be you have to divert that fund a future SIP to FlexiCap or any 6 fund which we have suggested. You can divert your SIP instead of doing SIP in ELS. You can divert your SIP into any of the fund. Now, as you are chasing, as you are expecting,
One
as your goal
question
is
to
to
you. One question to you, since we are talking on the overlap of the funds, you started your answer saying one should have only high performing funds in the portfolio. You have dissected the portfolio, you have asked him to exit a lot of existing funds or repetitive funds in the portfolio. How are you trying to analyze what is high performing and what is not?
So here, Kavita ji, high performance doesn't mean that the fund which is giving a good return, or maybe the on the return front they are topping the chart. Here, the when we talk about long term investment, it doesn't matter 1 or 2 years or maybe 3 years. Some fund is performing or maybe topping the chart. Here, it is all about the fund strategy. When markets are going down, what is their strategy? What are their risk management measure? Considering that you have to select based upon your risk appetite. Say he has invested in two mid cap and two small cap fund, right? So one small cap he is having a it is very aggressive fund. If customer is though a couple of years it was really performing good, but now small cap they are the con small cap is not topping the chart. Yeah, but when market will again reverse, the trend will get reversed. There are possibilities quant small cap might start performing well in that zone. So here we have to consider two things. First is the risk appetite of the investor, and second, the risk if the and the risk management of AMC particular, while going down, when market is going down, what strategy they are adopting. So I mean that, not the written wise.
All right. Let's talk about the corpus that he has to accumulate. What's the rough SIP amount that you're looking at?
So with current SIP of 40,000 rupees and the investment horizon is 10 year, if we assume that if his investment generate around 12% CAGR return, in that situation, he'll be accumulating close to 93 lakh, which is quite far from the goal which he has set for himself. So here he has three different option which he can choose. First is if we can increase his SIP from 40,000 to 85,000 immediately, in that situation he'll be able to meet the target. Second is if he's not able to increase SIP amount immediately, in that situation he has to increase the SIP from 40,000 to 60,000 and increase SIP by 10% every year. And the third is the target is pretty the target which he has set for himself is bit aggressive. In case if he's not able to do any of this, in that situation he has to extend his investment tenure from 10 years to 15 years.
All right. So that these are the changes that one needs to do in the portfolio. But one very specific investment that I would like to discuss with you is the commodities one. So we know this type of diversification is available through mutual funds that one can do. But how can one really diversify? Because see, when you talk about investing in commodities, a lot of people are just comfortable doing it in gold and silver. For that also we have gold funds, we have gold ETF, silver fund, silver ETF. We also have a category as called as multi-asset allocation funds, where you do have exposure to these commodities. How exactly is ICICI Pru Commodities Fund exposed across commodities? What type of commodities are we looking at, and how is it necessary for a person to have a pure commodity fund also in the portfolio? How would you like to explain?
A very relevant question. Say, this is a thematic fund. Commodity means that doesn't mean that a fund is actually investing into commodity. Commodity is a kind of equity fund only because here fund will invest into the stock which are into commodities, say like metal and mining, energy, oil, kind of they'll pick up the stock which are into the relevant sector, and they invest into that stock. So technically, it is a equity fund only. But theme is that rather than investing into various sectors, they have narrowed down to companies which are directly linked with the commodity sector. So here, metal and mining will be there, energy, chemical, everything will be covered into this basket. So when we talk about commodity fund, it is not necessary that person should have in the portfolio. Yeah, the person who like no this funds are good for the investor who are cyclical, like no invested in nature, when they understand commodity cycle really well, and whenever they wanted to like no, these are not the long term fund, long term kind of fund. If they feel like no, next 1 year, 2 year, or 3 year, maybe 3 years, this sector will perform well, they'll invest and they'll move out. Second is this is good for aggressive risk trade taker, because commodity, as you know, market like no, it is very concentrated fund. Possibility in case if some adverse impact, say like monsoon or any other thing, may have a good impact on the this particular sector, and there are possibility this sector may become very volatile. The third is like no, when the person has a very large portfolio and he wanted to have something new in his portfolio, those kind of investor can only go with this specific funds.
Let's move on. Also, before I move on to my other question, what's the kind of return expectation one should be having from this particular fund or this type of a fund?
Typically, like no, if we talk about last 3 to 5 years, this particular fund, like no, this commodity funds have generated close to 20-22% average return. But these are not the fixed return. If you see the long term scenario, generally we always say that whenever you invest, don't invest in any particular fund just because of return. You select fund which are helpful in terms of achieving your goal. So here our suggestion is like, looking at the portfolio return, please do not go with that. There are possibility you may see negative return. Average general, as per standard, we always say that while investing, always consider 12% CAGR return.
What should be your portfolio exposure in such kind of diversification? I mean, not more than 10%?
Yeah, between 5 to 10% based on the investors' risk appetizer, but should not be more than 10%.
Let's move on. Let's take Deepo Singh's question. He's from Kolkata. He's been investing since April 2025. He's got ICICI large cap, Motilal mid cap, HDFC mid cap, Bandhan small cap, Parag Parikh flexi cap, BlackRock flexi cap, and investing since almost a year now. His funds are in negative and he plans to invest for more 10 years. Interesting, and yes, definitely look at the markets. You should not be expecting your portfolio giving you the stupendous returns. But having said that, too much of mid cap in his portfolio, although he's tried having a pure large cap also and a Parag Parikh flexi cap. He's got BlackRock flexi cap, I think over diversified in that category as well. Can he cut it down?
Kavita ji, surely there are two mid cap funds, right? Motilal Oswal, it is a concentrated fund. The general and that suits for aggressive investor, and HDFC mid cap is a all-time good fund. So if customer is having a high risk appetite, in that situation he can continue with Motilal Oswal mid cap fund. Otherwise he can stop the SIP and divert the fund to HDFC mid cap. The similar thing, there are two flexi cap fund. One he has done one he has done the lump sum investment. The other one is where he is doing continuous SIP. From your show, I would definitely like to say one point here. Whenever customer is investing into any new fund, they do not have past track record. Second, how that fund will perform when markets are going down. So if you are long-term investor, that's good. But in that situation also, you should always invest in tried and tested funds. Say like you have one Parag Parikh flexi cap in your portfolio. No need to have another another flexi cap from BlackRock.
Okay, let's move on to a very important question that not only Deepo but a lot of other investors must be experiencing, that is negative returns in their investments, and especially the ones who have just entered in like 1.5 year, 2 years time, must be facing this problem in their portfolio. It's a very common tendency that either you stop your investments or you exit entirely. Why that should not be done? How should you tackle the negative returns in the portfolio that you are seeing now?
So, Kavita ji, as like no, this day IPL fever is there, so I would like to explain the situation in a cricketing by using taking an example from cricket. When any team is chasing a run, right? There are overs where that will go, they'll not be able to score a single run, and there are overs where they'll get 1 or 2 runs, and there are overs where they'll get maximum runs, right? End of day, if they require to required a 7 run per over, 7 runs per over. In that situation, like no, some good overs can help them to maximize the or maybe they'll take it closer to the asking run rate. Similarly, when it comes to stock market and particularly in SIP, every over, like no, every month you are investing in a money. There are months or years where you'll not get any return, but there are the year will comes where you'll get a maximum good returns, and all put together after 7 years or maybe 10 years, you'll see a 12 to 15% CAGR return. So our suggestion is always that, like no, if you have invested for a longer keeping your goals are for longer period, and if you have invested for longer period, stay calm. No need to, like no, don't take any panic decision. Say when you are investing in equity market, panic decision is the biggest enemy. So our suggestion is always there. Negative return will come. Market may go down. Market may be very volatile during certain phase. You should keep calm and just focus on, like, if you have selected a right amount of if you have selected a right amount of mutual fund scheme, right, a good fund is there in your portfolio. Keep it, hold it. After 10 years, you will see, like, your portfolio is has generated the 12 or 15%, whatever returns you have expected. That there are possibility 12 to 15% return you will get it after 10 years.
All right, so that is something that one really needs to keep in mind. If you are not in a position to, increase your investment amount, at least hold on to it. At least do not stop investing, because that could, in fact, hamper your returns in the longer term.
Yeah. Certainly. Say, Kavita ji, generally what we have seen is, like, no, there are studies which is published, right? Now, if you have missed only 22 good days, right, where you have not invested, you have stayed out of your out of you have not invested and you have stayed out of the market. In that situation, there are 10 or 12% good impact on your portfolio. So our suggestion is always there. See, this is not a new thing for the market. If you see the history of the market, the downfalls are always there. The volatility will be there. And while before investing, you should be always prepared about that. See, there are common rules available: 7532, 7531. There also, there are three situations for which you have the investor has to be always prepared. First is low return, second is negative return, and there are possibility where you may see no return over for a longer period of time. So you have to, as an investor, you should always have a control on your emotion. Market may go up, may go down, but as you have faith and you have selected a right scheme, stay invested. You will definitely get a good around 10 to 12% return over a bit of time.
All right, let's move on. Let's take other question. This is coming in from Shivam, and he's 30 from Pune, and he's been watching the show since last 1 year. Made a portfolio, doing couple of SIPs. He wants to invest for 20 years. He has 20 lakhs in PPF, and he's been investing 10,000 every month. SIP is of 25,000. He has given the list of his funds, Samir, that's there with you. Lump sum investment in Nippon Multicap. Portfolio value is almost 5,50,000, and he wants to do a lump sum of 4 lakh now, and he wants to understand if 1 lakh should be done in Nippon Multicap, 1 lakh should be done in Kotak Multicap, 50,000 in Parag Parikh Flexi Cap, and 50,000 in SBI Contra, 50-50 in mid cap and small cap. So he wants a strategy on that. He's a long-term investor. And Motilal Oswal mid-cap, he wants to know if he should be continuing or not. So, interesting question, SIP and lump sum. How can one balance it out? Let's start with that, Samir.
So, generally, Kavita ji, whenever, first of all, I would definitely congratulate Mr. Shivam, because these days, people are little concerned about the market return, and they decided to remain out of the market. Whereas he, like, no, this is the ideal. Like, no, if you really wanted to be a good investor, this is the right time to invest. And he has, like, no, he understood the core thing, and he is additionally investing in this. So this is really good, and I must congratulate Mr. Simam for this act. First is, like, no, let's talk about the. I'll talk about the Motilal Oswal mid cap. So obviously, if you are a long-term investor, you have a high risk appetite. In that situation, you can continue with the Motilal Oswal mid-cap. It is a concentrated mid-cap fund where, like, no, they have invested into 25 to around 30 odd companies. Larger post over a past 6 month, 8 month, you might have seen the lower return in the mid-cap category, just because they have a higher exposure in the IT sector. The IT sector, like, no, will definitely bounce back over a period of time. But if you have a good, say, if your investment horizon is 20 years, I'm sure you should definitely continue with this fund, and it will generate, like, it will be in if we talk about the mid cap category, it will definitely generate a higher than the mid cap category average return over a period of time. Now, second is, like, no, how a person should balance between the lump sum and SIP. So basically, SIP is a regular course, like, no, where you should definitely, like, no, once you have started discipline, you have to be disciplined in terms of, like, no, continuing your SIP. Lump sum, it is a tool which you can use in this kind of market. Say when markets are not in a good shape, markets are going down. This is the time where you should additionally invest. So as and when you have a surplus amount of money, markets are down, if you have to decide a strategy, say, like, every 5 or 10% down, I will increase my amount in, or I will do lump sum investment into my existing fund. So this is the right time to invest into, like, no, lump sum should be there, so it can help you to maximize your profit, return. Now, during this phase, right, if you are planning to invest 4 lakh, our suggestion is, like, no, it should not be a lump sum investment 1 lakh rupees into all categories straight away. Our suggestion, like, no, the better approach is, like, no, you should take a route of SIP, where you can, like, no, park your 4 lakh rupees into liquid fund, and transfer equated amount, like, no, whatever. If you are selecting, if you wanted to invest in 4 months, then divided by 4, like, no, whatever amount, 4 lakhs. So every month you can invest 1 lakh rupees into equity. So transfer your from liquid to equity.
Mm-hmm. All right, so in a nutshell, that's the advice coming up from Shivan, and with that, it's a wrap on the show as well. Thank you so much, Samir, for being on the show and helping our viewers with all their portfolio queries. And for our viewers, you can keep sending us your questions. The number is flashing on the screen, so note that down, and also the email ID where you can reach out to us. Thank you so much for watching. Goodbye.